The US dollar is once again under intense scrutiny as global investors react to political uncertainty and shifting economic expectations tied to Donald Trump's potential policy direction and leadership style. Currency markets have become more sensitive as traders weigh how aggressive trade policies could disrupt supply chains and weaken confidence in long-standing US economic stability. Concerns over renewed tariffs have resurfaced, raising fears that trade wars could return and damage global growth while placing additional pressure on the dollar's international standing. Market participants are also watching fiscal policy closely, as expectations of higher government spending could significantly expand budget deficits and increase long-term debt risks. A widening fiscal deficit often undermines investor confidence, particularly when paired with political uncertainty, making the dollar more vulnerable to sudden shifts in sentiment. Inflation worries are another key factor, as expansionary policies could push prices higher and complicate the Federal Reserve's ability to manage interest rates effectively. If inflation accelerates too quickly, the Federal Reserve may be forced into difficult decisions that could slow economic growth and unsettle currency markets. Interest rate expectations play a critical role in dollar strength, and uncertainty around future Fed actions has increased volatility across global foreign exchange markets. Some investors fear that political pressure on the Federal Reserve could undermine its independence, weakening trust in U.S. monetary policy credibility. Global central banks are closely monitoring these developments, as changes in U.S. policy can ripple through international markets and affect reserve management strategies. Several countries have already explored reducing reliance on the dollar in trade settlements, a trend that could gain momentum if uncertainty persists. The idea of de-dollarization has gained renewed attention, fueled by geopolitical tensions and questions about the long-term reliability of U.S. leadership. Although the dollar remains dominant, even small shifts in global reserve allocations can influence exchange rates and investor perceptions over time. Safe haven demand for the dollar has historically surged during periods of global stress, but political unpredictability could challenge that traditional role. Investors are increasingly diversifying into alternative currencies and assets as a hedge against potential dollar weakness and policy-driven volatility. Emerging markets are particularly sensitive to dollar fluctuations, as a weaker or unstable dollar can affect capital flows and debt servicing costs. Sharp currency moves can also impact global commodity prices, adding another layer of uncertainty to already fragile economic conditions. Energy markets are watching closely, since oil is priced in dollars and currency swings can influence both prices and international demand. Financial institutions are reassessing risk models to account for heightened political influence on economic decision-making in the United States. Equity markets often respond alongside currencies, as dollar weakness can boost exports but also signal deeper economic concerns. Multinational corporations are adjusting hedging strategies to protect earnings from sudden exchange rate movements linked to policy announcements. Consumer confidence can also be affected if currency instability leads to higher import prices and increased inflationary pressure. A weaker dollar may support U.S. exports in the short term, but long-term instability could outweigh any temporary competitive advantage. Bond markets are reflecting these concerns, with yields reacting to expectations of higher debt issuance and changing inflation outlooks. Foreign investors may demand higher returns to hold U.S. assets, which could further pressure the dollar if confidence continues to erode. Political rhetoric alone has proven capable of moving markets, highlighting how sensitive currency traders have become to leadership signals. Uncertainty tends to increase market volatility, and the dollar has not been immune to sharp swings driven by speculation and headlines. Some analysts argue that fears are exaggerated, noting the structural strength of the U.S. economy and deep liquidity of dollar markets. However, others warn that repeated shocks can slowly undermine trust, even in a currency as established as the U.S. dollar. Historical precedents show that reserve currencies can weaken over time if political and fiscal discipline is questioned. Global investors are increasingly focused on long-term sustainability rather than short-term growth promises and policy surprises. Trade partners are seeking greater predictability, as sudden shifts in tariffs or sanctions can disrupt planning and investment decisions. Currency strategists emphasize that perception often matters as much as data when it comes to exchange rate movements. As narratives around U.S. policy evolve, so too does the willingness of investors to maintain large dollar positions. The dollar's role as a benchmark currency means its movements have wide-reaching consequences beyond U.S. borders. Developing economies may face renewed pressure if dollar volatility triggers capital outflows or tighter financial conditions. Central banks may respond by strengthening currency reserves or adjusting policy tools to shield domestic economies. Financial markets thrive on stability, and prolonged uncertainty can gradually erode even the strongest foundations. The interaction between politics and economics has become more visible, increasing the dollar's exposure to non-economic risks. Election cycles often bring volatility, but the scale of current concerns reflects deeper questions about policy direction. Speculation around future leadership decisions has intensified market reactions to even routine economic data releases. Investors are paying close attention to official statements for clues about trade, taxes, and regulatory changes. Unexpected policy shifts can quickly reverse market trends, amplifying gains or losses in the currency market. Confidence is a fragile asset, and once shaken, it can take time to rebuild, especially in global finance. Despite challenges, the dollar continues to benefit from a lack of strong alternatives with comparable scale and trust. The euro and other major currencies face their own structural issues, limiting the pace of any dollar displacement. Still, incremental changes in global financial behavior can accumulate, shaping the dollar's future influence. Analysts stress that clarity and consistency in policy could quickly restore confidence and reduce currency fears. Until then, uncertainty surrounding Trump's policies is likely to keep the dollar under pressure and markets on edge. The coming months may prove critical in determining whether current fears fade or evolve into lasting structural concerns. Ultimately, the dollar's path will depend on how political decisions align with economic fundamentals and global expectations.